Welcome to Get Started Investing. Today we are back with another installment of the Best ETFs for series. ETFs are hugely popular and have exploded over the last few years, and we know that a lot of you, including us, have ETFs in your portfolio. So in these episodes, we're going to take an investing strategy or goal and try and find an ETF to match it. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. We are talking about the best ETFs for growth.
Yes.
That's why we all invest.
That's why we invest.
Most ETFs issued, not all, but most ETFs would put their hand up and say we should be considered for this category.
They would love to put their hand up. Yes.
Yeah. So
absolutely.
I think in this episode, we're going to start by just setting some parameters, talking about what is growth, what we mean by growth, and in particular, in this episode, what we're talking about, which is above average growth.
Yeah.
Those that are designed for above average growth. And then we'll get into a few different options and a few different products. So let's get into it. Let's get started. Define growth. What do we mean?
Define growth?
Yeah.
Wow. So Ren, simply when we're talking about growth, I want my money to appreciate over a long period of time. That is, simply put, that is growth.
I think importantly, we're not talking about income here. There's a whole different range of ETFs that are built to deliver income. And we're not talking about that. We're talking about capital growth, share price going up to the moon, baby.
That's it.
Yeah.
Now, we've spoken time and time again about the average returns of the stock market over the past 100 years being that 8 to 10%, and that is growth. There is nothing wrong with that. Your basic index products, S&P 500, ASX 200, these are products that are going to give you that stable long-term average market growth. In this episode, though, we're looking a little bit above that.
Yeah.
We want to go above the market average.
Yeah. I think before we move on to the above average, it's like if your takeaway from this episode is I need to invest in some of the products we're about to speak to achieve growth, we have absolutely failed in what we're trying to do in this podcast. Because like the first thing is investing in a low-cost index fund will deliver you growth over the long term and will deliver you the growth that you need to build a meaningful portfolio. So that's the starting point. But we just know that there's interest in alternative types of products and different products. And so when we're talking about above average growth in this episode, we're talking about products that are designed in their structure or in how they work to beat the index. And that's probably an important distinction because we're not talking about those index products that have absolutely ripped recently. Because like
above average.
well, no, they are by investing definitions, the average. The average has just been really high.
Yeah.
And so what we mean here is even after the recent fall, the American S&P 500 is up, like 20% in the past 12 months. The NASDAQ 100 is up even more than that. In India, the Nifty 50, their main stock market index, is up more than 20% in the past 12 months. But these are products that aren't designed to beat the average. These are products to just take the average of whatever that market is doing. It's just that those markets have done really well.
Yeah.
And importantly, we're not talking about them today.
No. But there's nothing wrong with that.
There's a lot right with that.
So when we're looking at growth for above average, there are three ways that we can do this. Three sort of things that we look for in products. There's leverage, there's active growth managers, and then there are thematic ETFs. So those are three buckets where you can look to try and start beating, or not beating, but try and start getting above average market returns.
All right, so let's take them one by one, and let's start with leverage.
Yeah.
First of all, what is it?
So leverage is where you essentially take additional money or borrow money to increase your position size. Think of it just like you leverage into home loans. That's the most common way that Australians would know leverage.
Yeah.
You take your deposit of $50,000, you go out and borrow $1 million, and so you've taken the bank's money to buy an asset to the tune of $1 million with only 50.
It's where each dollar invested gets you more than $1 of underlying investment. And there are two ways that it happens generally with ETFs. The first is, like your home loan example, the ETF issuer will go and actually borrow money. And then for each dollar you invest, they'll borrow money to boost it. And then the second way is there are products that use like derivatives and options and futures. They're like synthetic investment products that rather than investing in a stock, you're essentially making a prediction or a bet on the future movement of that stock. And that's a way to sort of give yourself leverage, amplify your money.
Yeah.
For us, when it comes to leveraged ETFs, we much prefer the first type rather than the second type.
Yeah.
We much prefer the going out and borrowing money from the bank rather than this synthetic leverage.
Yeah, you'll find that a lot of the US or international ETFs are the synthetic model. Luckily here in Australia, and we'll talk to a few specifics later on, but there are options here in Australia.
Why we like it is over the long term, that synthetic model, there's something called beta slippage. You'll never need to worry about what that is, but if you want to Google the term, you can. But it essentially means that the ETF and the underlying index, they start to drift a little bit. Whereas that first model, you get less of that.
Yes.
Which is we like.
Yeah, we like that. So look, there are leveraged options. Buyer beware though, it absolutely comes with risk because just like you get leveraged growth on the upside, you also do get accelerated growth, not growth, falls on the downside. So you can lose money very quickly as well. But if you are looking to get outsized returns, that's bucket number one.
So 2 ETFs that we think fit this bill. They're both by beta shares. Their tickers are GEAR and GGUS.
Geared, yes.
What are their actual full names?
So GEAR is the beta shares geared Australian equities and GGUS is geared US equities. GEAR is leveraged exposure to ASX 200 and GGUS is leveraged exposure to the S&P 500.
Nice.
So beta shares go out, borrow the money and they manage the internal gearing. They say a target range of 2 to about 2.75 times the daily return.
Yeah. So that's bucket number 1 in terms of products that are designed for above average growth. We should be clear as we go through this episode, that doesn't mean they always achieve above average growth, but we're talking about products that are designed to do it.
Yep.
So number 1 is products that are leveraged. Next up, we've got active managers and thematic ETFs. So let's start with active. What do we mean by active?
This is where we're looking at ETFs that are managed by professional fund managers and they are actively picking and choosing stocks and wrapping it up and giving you access to that fund on the ASX or on the US markets, wherever you may be buying them. So the big difference here with a number of the other ETFs that we've been speaking about and that are in Renault MyCore portfolios is that unlike an index, you've got literal fund managers here making active decisions. And so where this becomes interesting from a growth perspective is there are managers out there who call themselves growth managers and are literally trying to find companies that are going to give that above average growth and create portfolios to replicate that.
Yeah. Now, there are sort of 2 ways that you can try and judge growth managers. One's backwards looking and one's, I guess, forwards looking.
Yeah.
And you can be backwards looking and saying what growth managers have done the best over the last period of time, over the last 7 years, 10 years. You want to make sure you're looking long term. There's nothing wrong with doing that, but you may also find that a growth manager has had a really good period and you invest just as they start to underperform because no one stays on top forever, especially in investing. No strategy works forever. The other way that you can look at it, and we want to give a shout out to StockSpot here, and we'll include this link in our show notes, is they've done the work to look at what these growth managers are holding in terms of growth companies.
Yeah.
And so we're just going to talk to that list and some of the companies that they have assessed are holding the most growth companies. So some active managers to note down, to do your own research on. Coming in at number 1, Hyperion Global Growth Companies Fund. HYGG. Coming in at second and third is Monroe, their Concentrated Global Growth Fund, MCGG, and their Global Growth Fund, MAET. Mate, almost, come in at 2 and 3. So they're the podium finishers. And then coming in at number 4, a fund manager I actually haven't heard of before, WCM. Quality Global Growth ETF, WCMQ is the ticker. So those are some of the active managers that top this list, but as we said, we'll include the link in the show notes so you can do your own research and read that full list.
Yeah, and I think important to note as well that these are fund managers who are very well known in Australia for growth investing.
Except for WCM, we don't know.
Yeah. But particularly the first two, Hyperion and Munro, promote, and we've had them on the show before, both of which are actively picking those high growth companies. So not a surprise to see these guys up there.
Yeah, I should put my hand up and say I'm an investor in both Hyperion and Munro's funds.
Yeah. Now, just similar to leverage, though, there are swings and roundabouts when it comes to these funds, given the nature of the stocks that they are invested in. High risk, high reward. So you're likely to see a bit more, I guess, volatility when it comes to growth funds. But that's the second bucket, active growth managers.
Now, I want to put a disclaimer about active management here because they are designed to outperform the index. That's why they get paid. That's why they do what they do. That's why people invest with them. If they couldn't outperform the index, why would you invest with them? The challenge for a lot of active managers is there are some that are great and they do outperform the index. The majority don't. Now, S&P Global have a scorecard, the SPIVA scorecard, that tracks how many active managers outperform the index. Over the past 15 years in Australia, just 14.6% of active managers have outperformed the index. So I think that's just an important caveat when you're looking at active managers. They're designed to outperform the index. That's why we invest in them, but a lot of them don't do it. So keep that in mind.
Good disclaimer. Now, the third and final bucket when looking for growth is thematic ETFs. We've done a bit of a buyer beware when it comes to holding thematic ETFs for long periods of time, but there are moments, and if you are looking for growth, there are a number of ETFs that are designed to try and give you that above market average.
Yeah, now 2 ways you can look at thematic ETFs. Well, actually 3 ways. The first way is you can just find a theme that you really like and you can think that it's prime for growth and you can think that the thematic ETF is the right way to invest in it. But then the other 2 ways are you can look at past performance and then you can do what we did with the active managers and look at what their underlying holdings are, and the stock spot list that we'll include in the show notes has done that work for us. Funny, if you look at the underlying holdings or if you look at the past performance, there's one thematic ETF that comes out on top of both of those lists. FANG Plus, yeah. ETF securities, well now Global X FANG Plus comes in at number 1.
So just to put some color to that, past performance and underlying holdings, it's because it's a highly concentrated ETF, I think, of 10
tech stocks.
Tech stocks, yeah. And so like you think, okay, thematically tech is doing well. Let's take out the 90 stocks from the NASDAQ 100 and put the top 10 into an ETF. It's no wonder that it's coming out on top.
Yeah. Now, a couple of other names that top this stock spot list: BetaShares Global Robotics and Artificial Intelligence.
Yep, makes sense.
No surprises why that theme appears to be doing well at the moment. AI seems to be driving the market. BetaShares Online Retail and E-commerce ETF. I buy. I'm surprised by that one. And BetaShares Cloud Computing. Less surprised by that one.
So yeah, what we've seen there is thematics that have these tailwinds behind them and that these ETFs are giving you a, concentrated exposure to companies that are made up in that thematic. Others that come to mind, and I guess this is in the artificial intelligence, but the for example, semiconductors, that's one that's done well.
One that is quite popular is Hack, the cybersecurity ETF.
Yeah. So my caveat with thematics though, Ren, is you need to do the work on actually understanding the companies underneath it.
Yeah.
And if they are the right companies that are going to give you the growth in that thematic.
Yeah.
Because you might say semiconductor ETF, but if it's got all the companies in it that, if it doesn't have NVIDIA in it, you would have missed all of the growth.
Put it this way. If there was a semiconductor ETF that was equally weighted between NVIDIA and Intel, that's not a great outcome for you.
No.
Because Intel is not doing well, and NVIDIA obviously doing well. So yeah, you're right. You've got to look at the underlying holdings. Another disclaimer when it comes to thematic ETFs, there's been a lot of disclaimers in this episode, is themes don't last forever.
Yes.
You know, like lithium was a great theme for a while. Look further back, medical marijuana was a good theme for a while. That had a run. Right now, AI is a theme that's having a good run. But themes don't run forever. And so when you're thinking about investing in a thematic ETF, this isn't a buy and hold, dollar cost average, put it in the bottom drawer, checking it on 30 years. This is think of it almost like investing in an individual stock. So there's nothing wrong with it, and they've done really well for a lot of people, but those people sold at the right time.
Yes. So 3 ways: leverage, active growth managers, and thematic ETFs. 3 ways that we think you can try and find above average market returns if you're looking for that high risk, high reward. But before we close out, we have a question that has come in from actually our producer, Sophie.
Hello, how are we?
Good.
Good.
So, when I was doing some research for this episode, looking at those growth ETFs that will get you the above average, this term kept coming up called aggressive ETFs, and I'd never heard that before, and I've kept seeing it everywhere. Aggressive ETF, aggressive ETF. And I was like, what is this? Is it going to bite me both metaphorically and physically? I'm scared.
Nice.
What is an aggressive ETF?
Good question.
It is a good question.
We had to do a bit of digging on this one.
Yeah, I think first things first, it's not a term that you'll see in Australian ETFs. It's a term that you'll see in American ETFs. But these days, we can all invest in American ETFs. Well, most of us can, depending on what broker you're with. So it's worth exploring. So where do we start?
So from what we can tell, Ren, it is essentially another word for growth.
Yeah, high growth. In Australia,
High risk, high growth.
In Australia, we've got Vanguard Diversified High Growth ETF, which is 90% in stocks, 10% in bonds. And it seems like in America, aggressive is kind of used interchangeably with like that high growth. And we came across a couple of examples from iShares. The iShares Core Aggressive Allocation ETF, which when you look under the hood, has 20% exposure to bonds and 80% exposure to stocks, which actually doesn't feel super aggressive to me.
I think there's a number of lists, a couple of others that are popping up. It's what everything that we've just spoken around. A lot of them revolve around tech. A lot of them are thematics. Some of them have leveraged. There's one here, the Direxion Daily Technology Bull 3 times.
But that doesn't have aggressive in the name.
No, but it's under a list called aggressive growth.
All right. Well, how about this one that does have aggressive in the name? The iShares ESG Aware Aggressive Allocation ETF.
Okay.
Feels just, I don't know.
I agree with Soph that the terminology here is a bit off-putting and can be a bit scary.
It's a bit aggressive.
It's I think what we're seeing though underlying it's potentially not so much.
Yeah. I think when you see aggressive allocation, think high growth.
Okay.
Yeah.
So it doesn't surprise me that it's a US thing because it feels very American.
Yeah.
But none here in Australia, at least, have that in their names, or at least that we could find.
Okay, cool.
So the adoption over here is growth or high growth. Or conviction, high conviction. You might find others.
Yeah. High conviction will be active.
Yeah.
Yeah. Anyway, a lot of buzzwords out there.
Yes.
Make sure you're listening to Get Started Investing, and one by one, we'll slowly chip away at all that jargon. If you have a piece of jargon that you want us to explain, or if you have an ETF or an investing theme that you want us to go deeper on, let us know. Hit us up at equitymates.com/contact. We're keen to answer your questions. And if Get Started Investing has helped you get started on your investing journey or become a more confident investor, would love it if you could give us a review on Apple Podcasts or Spotify, or leave a comment on YouTube, however you engage with the show, and tell a friend about it. Help a friend get started investing and help us grow and reach more people. But look, until next time, Bryce,
Love it.
We'll leave it there.
Sounds good.